You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
You are listening to Mining Stock Education, and in today's episode, you will be hearing from Jordan Roy-Byrne from thedailygold.com. Jordan, as most of you would know, is a market commentator in terms of the gold price, where it's headed, macroeconomics, as well as commentating on and finding picks for his subscribers for the junior mining sector. So Jordan, welcome back on to Mining Stock Education, and I'd like to get your thoughts first on where you're seeing value in the junior gold sector. It's commonly said that the best way to profit is to find a common misperception and then bet against it. Are there any misperceptions in the junior gold sector that you're seeing right now and that you're hoping to profit off of?
Well, hi, Bill. Thank you so much for having me. And we were talking about this beforehand, but it's interesting to me, and it's something I just started realizing in maybe recent weeks or recent months, is I like the value in a handful or more of development stocks. I think a lot of people in our industry, they obviously are focused on exploration, which is great. Exploration can be a huge value driver, even for producers. I mean, we've seen some junior producers just perform fantastically thanks to exploration. And obviously, in the looking at pure exploration companies, that's where you can find a lot of 10 baggers and even more gains than that. But looking at developers, just looking at some of them and running the numbers, I think that there's a chance that if over the next, let's say 2 or 3 years, we see gold break above 2,100 and make a run towards 2,800, maybe even 3,000, I think that there's development companies right now that if we see that gold market and they're able to successfully build their mines, I think that there's potential for some 10 baggers there. Now, not a lot, but maybe more than a few. And I say that because there's a couple things going with developers, Bill, and that's the re-rating that you get from just being a late stage explorer or someone who you're thinking about building the mine, and then you eventually go from raising the money and building it to becoming a producer. You get such a huge re-rating in your valuation. And so if you look at, you can have what they trade at against net asset value before they build the mine, it can be anywhere from, 0.2, 0.3, 0.4, maybe a little higher in some cases. But once you build the mine, I mean, there's a pretty good chance you can be trading at 1 times net asset value. And so I like to look for several things here with developers, and that's do they have a project that is producing at least 100,000 ounces a year? Is the project scalable? Does it have some upside? So maybe the study says they're going to produce 100,000 ounces a year, but they say, well, once we get it going, we're going to expand it a little bit. Bring in some more ore, whatever, and then it can go to 130 or 150. At the same time, maybe there's a company that's they're going to produce 150,000 ounces a year, but they say, well, we think we can, a year or two after we start, we think we can get this up to 200,000 ounces a year. So you're getting, that brings in the element of production growth in addition to a huge valuation increase. And we're not even talking about the gold price, which if it goes from 1,900 to 2,300, 2,500, then you have all these factors that are driving some huge gains in developers. So I really like to look for the things I like to look for are, is the project scalable? And also, can the company finance it and build it themselves? Because what I mean is if you have a company that has a market cap of, let's say, 100 million or 150 million, but they have to raise 500 or 400 million to build the mine, it's really difficult for that to happen. It's just too much it's too much money to take on. You can't take on that much debt. You can't dilute your shareholders that much. So if you have a developer, the project is scalable. It's a project where the company is big enough where they can finance it. It doesn't have to be a particular number, but maybe it only costs them 200 million to build, or 150, or maybe a little more than 200 million. If that company can successfully raise that money and build the mine, then they're going to be in a really good position. So that's where I am finding a lot of value. And I found some companies there, but I'm really hoping I can find a lot more. And I think aside from the obvious things, what I would also tell people is, and I'm bringing it back to exploration, look at exploration, because if there are some companies that maybe they're just building the mine or they've started production, but there is some exploration upside there where they can add to their reserves or maybe expand production. Those are also some areas that we can look at for companies that can fulfill a lot of upside potential. So that's a little bit past the development stage, but I think those are things that I'm really focusing on right now and where I'm seeing a lot of value in the junior sector.
So if you're buying a development company, when you're doing your assessment, you're actually, if I understand you correctly, looking at this as a multi-year hold if you're planning on holding it through the construction phase into hopefully the ramping up of production. Is that right?
Correct. Yeah, that's an excellent point. And I did just do an update for subscribers, and so I'm looking at what's the potential upside for some of these companies, let's say 18 to 24 months, and then 2 to 3 years. So it's hard to be a buy and holder in this sector. I think not to segue, but the easiest way to deal with that is if something makes a really big move, goes up a lot, you have to sell a third or a half and let the rest of it run. So, but other than that, if you want to be a buy and holder, look at some of these development plays because you can hold them for 18 months, to 2.5 or 3 years. So yes, that's right.
Yeah, it's a little harder too to stay, if you're looking for a quick dollar, to stay in a development play. I had a CEO ask me a question earlier this year. He said, "Hey, how do you think we can get people excited about our story?" And I said, to be honest with you, most retail investors are not going to get excited about your metallurgical results and the fact that you're at least 4 years away from production. Those stories, they are harder to get excited about. But if you can get the gold moving in an upward direction, it's easy to get a triple out of. And then if you're like yourself, where you have a long-term perspective, maybe on a 5-year play, you could get a 10-bagger, would you say, on something like that?
Yeah, no, absolutely. And as far as valuation, another point that we're getting at is if you look at those charts of the junior life cycle, there's two best points to really buy. And the first is, as they're making a discovery or before they make a discovery, which is, that's really difficult to time and know who's going to make a discovery. It's really a form of gambling. I like to say we want to try and ride the wave. Like if a company is making a discovery, you want to get on that wave early on and ride it where the discovery can grow. But to me, it's a lot easier to buy at the other point in time, and that's at the end of the development cycle or in the late stage before they build the mine and become a producer. Because the worst time to buy is right early in the development cycle where they're doing metallurgical studies like you're talking about, and they're doing all the important things that tell the market if they're going to be able to permit and build this project or not. However, the market doesn't care about any of that. So you have to be careful. You can't get into a developer way too early in the cycle. You have to get in later in the cycle where it's closer to the point where they're going to be raising the money, or maybe even a little bit after that. It's different with every company. And at the same time, you also have to look for things that have value. Look for some of those companies where it looks like they're going to be able to build the mine and raise the money, but maybe they're trading at only 0.1 times NAV instead of like 0.5 or 0.6. Then those companies have a lot more upside potential if they're able to actually build the mine. So those are also important factors to consider. And finally, no, I agree with you. If you can hold for 2 or 3 years, you might have a chance to get a 10-bagger in some of these stocks. And who knows, maybe if they're only a 5 or a 7-bagger, we're getting greedy here. That sounds really good to me, honestly.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700-ton-per-day mill with an 8 million-ton tailings facility ready to be used. There is already power to site, and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year, or over 60 million billion pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com. Jordan, you mentioned lower capex projects is what you look for, but if you get a world-class project, you're looking at $1 billion plus capex usually to build something that's going to produce 500,000 ounces per year, which is what a Barrick is looking for. Would you view one of those as more of an optionality play, because the capex is so high, and would you ever buy a stock like that?
Yeah, I think those are more optionality plays. But I mean, I'll just push back a little bit on what you said, because I think you can still get, if it world class, maybe something that's not that large, but I think you can get 200,000, 300,000 ounce. Not a lot, but there's probably a few out there where or at least Barrick and the majors, if something is world class in terms of the economics and the cost and the grade and all those sorts of things, and if it's only producing 200,000 or 250,000, I think majors are still going to want those projects, because if they're world class or close to it, tier one type projects and the costs are relatively low. You can get those built for 200, 250 million, maybe even 300 million. And they have really good economics. Those are still the projects I think that majors and really everybody wants. So yeah, when you're talking about 500,000 ounces and capex getting towards $1 billion, and when you get into that territory, those are really optionality plays, in my opinion.
Yep. And when I define world class as 500,000 ounces per year production for at least 10 years, because that's what Barrick is looking for. So that was what was in my head when I said that. But you have subscribers that reach out to you, so you get feedback on an anecdotal level of what people are looking for, interest, frustration of what's going on in the sector. What can you share with us about the sentiment that you're picking up on right now?
Well, I have a number of thoughts on sentiment, but I will say a week or two ago, there's the daily sentiment index, and that was pointing towards lows. And one thing with that, I don't look at the daily readings. I look at, what's the 20-day or 18-day average. So I like to look at that. And so that was pointing to a rebound coming in the sector. Another thing is that the commitment of traders report and the net speculative positions. And that report has, we saw back when we had the big run in the summer, the run was so strong that I think you actually had commercials. They had to actually cover their positions. And so when the market gets really strong, you see that happen. And that's kind of, it's affected the reading of the COT, the net spec positions. They're still fairly high, even a couple in the last week or two, or 2 weeks ago, I should say, when the metals sold off towards their bottom. I didn't see any real decline in the net spec position. So that's one factor that's a little, it concerns me a little bit that we haven't seen more selling from speculators. But that's really one of the only negative things right now for the sector. But getting back to sentiment, anecdotally, and you have to be careful. You need to look at the data, things like the COT and the DSI, and then also weigh that anecdotally. And it's interesting because you look at, I could just anecdotally, there was somebody send me an email of someone on Kitco talking about, well, this could be 2011 again. I saw something on stock charts. There's a technician, Martin Pring, who is he's one of the well-known, old timer technicians. He's written lots of books. I love him as an author, but I saw that he wrote something that said maybe the gold bull market is over. I got an email. Somebody else was saying the same thing. Is Bitcoin taking over gold? So yeah, and mind you, all these things were happening as the mining stocks were coming down, correcting, getting close to really, really strong support levels. Same thing with gold coming down towards 1760, 1770, really strong support in there. So yeah, we were starting to you start to hear these things around the bottom and not a top. And those things were very encouraging. And I'll just repeat one more time. When you're looking at anecdotal factors, these things should be taken alongside of hard data. So that's what I like to do. Look at the DSI, look at the COTs, and then factor in anecdotal evidence, because people they'll say, oh, well, I knew it was a top when, my shoe shine guy was talking about it, or Uber drivers are buying gold stocks. I knew it was the top. Yeah, that may be true, but look at some hard data. Use the hard data, match that along with anecdotes, and you'll be pretty good as far as predicting the turn.
So have we seen a near-term bottom then?
Yeah, I think we have. I mean, I like to be on the conservative and cautious side, but in my update this weekend, I said most of the things that I'm looking at, the weight of the evidence really is very encouraging for precious metals. I mean, you had significant corrections in the gold stocks, as well as gold coming down below 1,800. Bill, gold corrected 15%. And historically, if you look at what happened in 2009 and 2004, gold corrected exactly 15%. So I don't want to beat my own chest when I say this, but back in the summer, I was looking at history and I said, well, gold the history says we could have a 15% correction and come down just below 1,800. And I'm looking at comparable periods. I mean, nothing is a perfect comparison, but I'm looking at 2004, 2006, 2009 for gold when it had corrections after big moves. And basically in terms of time, those corrections lasted only 4 or 5 months. And when I put together the rebounds from those corrections, those forecast an average of gold getting back to, I think, 2,000, maybe even 2,100 in June. So I'm not predicting and investing based on that, but that's just a guide of something that history says is possible. So I like to be cautious and conservative, but when I look at a lot of these factors, they tell me that at least over the next several months, it looks like the way the path of least resistance is going to be higher. It doesn't mean it's going to be pretty every day. We may have to grind higher, but I do think we've seen an important bottom, especially in terms of price. I don't think we're going to go lower.
What's the biggest macro risk for gold investors right now?
The biggest macro risk is the continuation of what has happened in the last 3 or 4 months, which is the market, or maybe the last 2 or 3 months. The market has been focused on the recovery side of the angle more so than inflation or reflation. So the market, they've been focused on the recovery, and inflation expectations have been rising. But in that type of environment, that tends to favor, at least initially, it tends to favor things like the stock market, emerging market stocks, and also commodities that are not precious metals. So the risk would be that we see a continuation of that trend well into next year. Now, even if that continues, I still think precious metals can do well, but precious metals need to overcome that and perform really well in relative terms if we're going to see a huge move higher and a huge breakout. So I don't see evidence. I mean, this may change, but I don't see evidence that we're going to have a huge breakout move beyond this recovery that I just discussed. So that is really the negative side. And look, because gold has been driven by economic fears, zero interest rates. It's been, and that's also helped the bond market. So we're seeing as we see the market start to bet on a recovery. We see that trade, the fear trade, you could say the zero rate trade. We see that unwind. We see bonds selling off, long-term interest rates ticking higher. We see that happen. Capital flows into emerging markets, stock market, commodities, at the expense of precious metals. But at the same time, Bill, precious metals, we did need a correction. So that kind of explains what's happened in the last couple months. And so that would be my question coming in 2021. Are we going to see that trend of the last couple months? Is that going to continue for the bulk of 2021? If it does, I have a hard time seeing huge breakout moves in precious metals. But that being said, we are coming off what could be an important low here in the last week or two. So there's a lot of nuance to that view, which is we're at a low, we're going to see a rebound, probably a good move at the start of the year. However, a lot more needs to be done for me to be confident that we're going to see a huge breakout move in the next 3, 6, maybe even 9 months. So there's a lot of nuance to that view.
Jordan, before you go, you have a subscription that is open to the full spectrum of gold investors, but you've also kind of offered more of a narrow subscription for gold stock investors and resource investors. Before you leave, please share about that.
Okay, well, this is for high net worth investors who like to speculate on things like private placements. It's called the Daily Gold Elite. So that's another offering I have. If anyone fits that, you can email me at jordan@thedailygold.com and I can explain everything we do. And so, yeah, really happy with that so far. I mean, there's a lot of value out there, even still in gold and silver, but there's even more value potentially in other commodity sectors, which are just started to get going.
All right. And Jordan's website again is thedailygold.com. Jordan, thanks for coming on the show and for this update.
Thank you, Bill. It was my pleasure.